So in this video, we're going to be looking at the next part of calculating commission in a complex environment, which is to look at sales levers and how we might go about calculating them, what their value is, and why we might want to treat them independently of sales commission as a whole. So the problem that you're likely to have been presented with is that you've been asked to calculate sales commission. And to be able to do that, you need to decide what's in scope and out of scope. And for a lot of organizations, you would pay commission on new business, but perhaps not on renewals. That varies from organization to organization. And there'll be lots of different rules and lots of different schedules, but broadly, this is a good one for us to start with. So determining whether something is new business or a renewal or a cancellation, that's a categorization of activity that we can refer to as sales levers, sales drivers. Again, terminology may vary across organizations, but these are fairly common terms to use. Typically, the way that people would approach it is to look at sales commissions as a whole bundle, as a singular process that has to do everything in a completely self-contained way. So it has to categorize activity to say this is relevant or it's not. It needs to track who commission should be paid to at what point in time. And then it needs to calculate what the level of commission that should be paid to those individuals. And the thing that happens very quickly with that is it starts to become very complicated. And also what you end up building if you follow this kind of approach is almost like an island, a data island in a lot of ways. You end up replicating, you take bits of logic that are relevant for the organization as a whole, and you kind of build a wall around them. You put them into your commission process. And that makes it very difficult for them to be shared with other reports and other processes. And we'll come to some of those in a few moments. But there is a different way that we can approach this, which is we start breaking the problem down. We start breaking apart what are the components, what are the subcomponents that we're talking about within sales commission. And if we look at sales levers as being one of those core components, we can start to look at it in a little bit more isolation, and we can start to think about, well, what are the uses of sales levers, sales drivers outside of commission? Another way of framing this question is to say, is the only thing that owns sales levers a commission? And the very likely answer is no, it isn't, because it's an enormously useful categorization that can apply across lots of different types of reports. So that might be sales forecasting, revenue forecasting. It might be churn modeling. There's lots of different utility for being able to categorize any given sales activity or revenue activity beyond the scope of just commission. So when we start to look at it in its own right as a distinct kind of sub-process, what we're also doing is we're developing what we would refer to as a separation of concerns. We're putting some boundaries around each of these sub-processes and saying, well, each of them can change. Each of them can have its own responsibilities and its own rules and its own life cycle that is independent of anything else that touches it. So, for example, we might go and change our commission schedules, or we might go and change team structures, but that doesn't directly impact whether something is new business or not, or whether it represents a renewal or not. So by putting some boundaries around these things, then it means that we can start to change them independently of each other. And that has implications for reliability and things like testing. So if we want to test the process of moving someone from one team to another and that they're being paid the correct level of commission, again, that forms a distinct set of functionality in its own right. It doesn't change how commission is assigned. The amount that they're paid would be different, but mechanically, we can test that in isolation without having to potentially impact every aspect of sales commission. One of the further benefits of breaking this out is what we're doing is creating an asset. We're creating a reusable asset, a data asset, where any report or any activity that needs to know whether revenue is categorized as new business or a cancellation, it's now centralized. any report in our business, any future requirement that comes up, there is a singular source of truth for identifying whether something is new business, renewal, upsell, downsell, any of those sales levers or drivers that we want to assign to it. So that gives us flexibility, gives us, it opens up opportunity to be much more agile in the way that we're able to respond to, the relentless demand of financial reporting requirements that come in every single day. So we've covered some of the benefits of approaching this calculation as an independent sub-process and making it a shared asset. But the next thing that we need to look at are what are some of the kind of pitfalls in the specific way that you might want to go about calculating new business, cancellations, that kind of thing. So it can be very attractive, and I've seen this done quite a number of times, to look at how what I would refer to as the operational teams are using software systems like ERPs and CRMs and that kind of thing to record customer activity and using that as a way to determine whether something is a new business or an upsell or a renewal. So to give an example, let's say, a customer gets in touch and says, I want to renew my subscription, but I don't need all of these extra options. I just want this one particular option. From an operational perspective, whether that's the account management team, a customer service team, but a team that's fielding this request, very typically in that software system, in that ERP or CRM system, they will enter a series of codes or they'll add a series of records against the customer that help track the activity. The customer wants to downgrade, the customer wants to add this package, the customer wants to remove that package, the customer wants to renew. And in some organizations, there can be, tens, hundreds, I've seen thousands of these codes used to track all of those very specific activities. Now, the thing is, they tend to be designed from the perspective of those operational teams and the way that those operational teams would need to report on their activities. They don't tend to be designed from the perspective of how finance need to report on those acts. And so it's quite important, I would say actually vital, that finance are able to calculate whether something is new business or cancellation or upsell, downsell, independently of how the customer record has been coded by the operational teams. And there's a number of reasons for that. One reason is the way that customer service teams, sales teams, account management teams implement their processes changes over time as people are promoted, as new leaders come in, as organizations reconfigure themselves. Those processes can change, and they can change quite dramatically, or they can change very subtly. But the point is there is change. And if you tie the way that you calculate the financial impact of a customer activity specifically to the way that it's recorded by the operational teams, what you're actually doing is giving an operational finance view of activity, not a finance view of activity. And that sounds like it's kind of splitting hairs, but it's a really important distinction. And I've seen this go quite wrong, that I worked on some very large projects where they'd exclusively used the operational coding to try and calculate ACV, in this case, annualized contract value representations of sales activity and the sales levers. And it just became a complete mess. There was no way of being able to unpick years and years and years worth of changes that had happened at an operational level to the way that the codes are recorded and so on to arrive at a sensible or reconcilable number that described this is how much new business has been done. This is what cancellations have been applied. These are the renewals. So there is a different way that we can approach that, fortunately. We don't need to tie it to that operational coding. And hopefully I may have convinced you that not tying it to that operational coding is a good idea. So how do you actually approach it? Well, it's going to vary depending on what the thing is that you sell. What is it that drives your revenue? If you sell subscriptions of some sort, it tends to be that you can calculate the start of the subscription and the end of the subscription. You'll usually have a start date and an end date, something that represents when this subscription starts and when it ends. You will likely also have something that refers to when the contract was signed. And between those 3 dates, that gives you an enormous amount of scope for being able to decide when you're going to recognize the sale. Some organizations would recognize the sale when the contract is signed. That's when the commitment has happened. Other organizations would recognize it when the subscription actually starts, because that's when the customer is gaining value. It's not to say that one is right and one is wrong. It might be your organization wants to see both of those views, and it's equally valid to see both of them simultaneously. But usually you will find those 3 dates are present somewhere in your system. You will also very likely find a contract value, some numeric value that describes, in whichever currency it is, what is this contract worth. And with that, you can attribute the amount of revenue that is going to come from that contract with one of those dates. Now, obviously, that's not accounting for revenue recognition. That's not accounting for, okay, this is a 12-month subscription and we receive a payment every month. And there are different ways that we can deal with that kind of activity. ACV is one of those. We can look at billings, but we're not necessarily talking about revenue recognition in terms of a cash position. We're talking about revenue from a sales perspective. So it's revenue attached to sales activity. So once we have that, if we know that a subscription starts on a certain date, what we need to do is look for that particular customer. Do they have any break in their coverage? Do they have one contract that ends the day before, the week before, the month before? Again, there will be specific rules within your organization that determine what is considered to be a break or not. What you'll probably start to see quite quickly is there are potentially a lot of rules associated with determining even something like a break-in cover, because that could differ from product to product family to product family, customer to customer. They can be on all sorts of different plans. And this is just talking about calculating new business, for example. So immediately we can start to see that sales drivers, sales levers will tend to have a lot of business logic associated with them. And this is perhaps another reason, or hopefully another justification, for pulling this out of sales commission. So we've talked about having these potentially 3 dates, a sign date, a start date, and an end date. And we can start to look for a given customer if we can list out all of the subscriptions that they've had for the last 12 months, 18 months, whatever it might be. We can start to see whether we've got the ability to calculate whether there have been breaks or not. And we can put some business rules around those breaks. So we can start to put some business rules around those breaks to determine whether the break is sufficient for this activity to now be treated as new business. Well, the customer stopped using our product 8 months ago, and our rules say that if they've not had our product in the last 6 months, then they're treated as new business. Or, we might say, okay, well, if they've had any of our products in the last year and they get a new product again, then it's considered to be a renewal. It's not considered to be new business. There's all manner of different rules that will be relevant to your organization. None of them are right. None of them are wrong. They're just going to be very different. And it's all going to be down to your individual sales strategy and reporting strategy. But now we've got those 3 dates and we can determine something from them, and that's very useful. But actually, once we step out of just determining that one thing, like the break, for example, to see whether this is new business or not, it starts to get a little bit more complicated, because if we start to get midterm upgrades, for example, someone's 3 months into a 12-month contract or subscription, and then they decide that they want to add 2 extra options to their bundle. And then 3 months later, they want to remove one of those and add something else. So the thing that we have happening here is we've got our start and end dates. Let's say we start on the 1st of January, we end on the 31st of December. But in between that, we've got a whole series of events that are happening. And actually what we need to be able to do is record those events in the months that they happen. So the next thing that we need to do with this data, and it feels very much like we're going to explode the volumes of data that we're working with, and we kind of are. But the great thing about most modern computing technology that we've got available, and Excel definitely fits within that, is they're usually quite good at dealing with lots and lots of rows of data, and that's what we're going to be creating, lots of rows of data. So in your system, you will very likely have a record of subscriptions related to customers, and there'll be 3 dates. There'll probably be more than 3 dates, but there will usually be at least 3 dates. One that represents the date the contract was signed or the subscription was committed to, the date that the subscription actually starts or kicks in, and the date that the subscription comes to an end. As I say, you may have more dates than that. You may have other dates. They might be called something different, but generally you'll have some data in your system somewhere that describes the relationship between a customer, a subscription, and what dates are associated with that subscription. So once you have that, you can start to do all sorts of calculations. We can see that, for example, for this customer, we have a single subscription. But if there was a previous subscription to this, subscription 0, for example, and that might have been signed in the previous year, it may well start on in January 24 and end in December 25. We can now start to calculate whether there has been a break in cover between these 2 subscriptions. This one ended on the 24th, this one ended on the 31st of the 12th, 2024, and this one started on the 1st of the 1st, 2025. The rules for your business may state that if there's been a break of more than 1 month, 3 months, 6 months, that this new subscription should be treated as new business. Or it could be that if the customer has had any subscriptions in the last 12 months, then this is just treated as a renewal. But just having the data in this format allows us to do some calculations that are independent of however it's been recorded by the operational teams. And if we add a value to this subscription, it might be that the one from last year was worth 800 and the one from this year is worth 1,000. And again, having that data available to us, which is very likely available in your system somewhere, means that we can now calculate, well, there was a break or there wasn't by looking at the dates and applying some rules. What's the number of days, the number of weeks, number of months between those dates? And then we can also look at the change in value. What's the delta between these 2 values? And we can use that to determine, is this an upsell? Is it a downsell? In the case of renewals, is this like for like? In some cases, we might have rules that say, okay, well, if the renewal value is within a certain range, within 20%, 30% of the original contract or the original subscription, it's considered to be like for like. Again, there will be a whole multitude of different rules for different organizations around that, and none of them are right or wrong. It's just whatever suits the organization. So this data in this format gives us a lot of utility. But when we start talking about slightly more complicated scenarios, such as a customer decides halfway through or 3 months into their contract, they decide they want to add one package and remove another package. Just having data in this format, it makes it quite hard for us to do any meaningful calculations. We can do them, but it starts to get quite complicated to understand what is the impact of something happening in March to this subscription or this contract. And so what can make our lives much easier is if we start to explode that data out a little bit. If we're able to have a representation of this subscription at a monthly level. So we go from having a single row for this subscription into having 12 rows, one for each month that the subscription is going to be active or expected to be active. That opens up a lot of possibility, and it also simplifies a lot of the logic that we need to work with. So if we look at this sheet here, we're looking again at subscription number 1. But what we've done is we've now exploded it out. So we've got our 12 rows, and we've got one row representing each month that the contract is going to be active for. Now, of course, we can't sum up the value associated with that contract. So it's one of the things that we have to be careful of. We're not saying that this contract has suddenly become worth 12,000. It's still worth 1,000. What this is actually saying is the value of this contract as a whole in any given month is whatever it was signed as. It was 1,000 in this case, and whether that's pounds, dollars, euros, any currency. So what we can do in any given month then, if we were to look across lots of customers, is we would immediately be able to, and quite simply able to, calculate the subscriber base as a side calculation that we can do. What is the total value of contracts or subscriptions that are active at any given point in time for our business? But then what's also very likely in your business, and this will be recorded in part by the operational teams, are events that happen. Customer calls in March and says, I want to get rid of this package and I want to add another package. So this is our kind of representation of the subscription at a monthly level. But somewhere else in your system, you will very likely have something that describes customer, a subscription, and some sort of event or change. And this can be represented in all sorts of different ways. It's very often some sort of activity record, and it will have some sort of description, and there'll be some sort of code. And ultimately, what that allows us to, and there'll be a date, and ultimately what that allows us to do is record that there has been a change to say, remove product A, and that might have a code of 001. That might have a code of 001, and that might have happened on we'll keep things easy for ourselves for now, on the 1st of March. So what that's telling us is there has been an activity to remove a product from the customer's subscription 1 on the 1st of March. And what we'll also likely see in the event that the customer called to remove one product and add another one, there'll be another activity. And, the number for this might be 002. And that happened on the exact same date, that the customer removed one product and added another. It's very likely that there will be some financial value associated with that somewhere. It's not always easy to get at because it depends how that's structured in your ERP or your CRM or wherever that data is stored. But there will usually be a way to determine the financial value of that change happening. So it might be, let's say, minus 200 plus 200. So in this case, what we're saying is the customer removed a product that was worth 200 and they added another product that was worth 200. So from a financial perspective, we can now overlay these activities onto our timeline, because that's effectively what we've developed here, is a timeline of a subscription. And we can start to overlay these activities onto our timeline. Now, from an operational perspective, we might say, well, this represents an upsell, a downsell, and then an upsell. And that might be what these codes refer to from an operational perspective. But from a financial perspective, that's netted out to 0. So actually, there is no meaningful change whatsoever in the value of our subscription from start to end. Nothing has happened that is financially significant But by going through the process of calculating in this way and using these data sets in this way, it allows us to remove some of the complexities and some of the issues associated with relying on operational coding to define the financial view of what's happened to a subscription. We're looking at those codes to indicate activity, and wherever possible, we would take the value, and even if we have to calculate that value or make some assumptions about that value, if we structure it in this way, we're compartmentalizing and putting into small components, little chunks of logic that help make our lives a little bit easier.